We're seeing the caution flag waving this morning as we enter the pre-market session.
Definitely.
While we're broadly neutral, the selling is very centered. S&P 500 futures are tracking down around 0.35%, but the real leadership in the decline is clearly tech.
Oh, without a doubt.
Nasdaq 100 futures slipping 0.6%. Tech is bleeding first, which, it immediately tells us where the market sensitivity lies.
And that sensitivity is fear of the calendar. I mean, we are bracing for a critical, dense week of U.S. economic data, and investors are just frozen.
Holding fire.
Exactly, holding fire ahead of November's non-farm payrolls, retail sales, and the big one, the CPI inflation report. No one wants to commit capital ahead of those potential macro shocks.
And beyond that immediate, let's call it calendar paralysis, we're seeing two other forces really compounding the decline in tech. One, that continued structural selling pressure we've been tracking for weeks, and two, you've got falling crude oil prices, which impacts the energy sector's weighting. So the hook for the week isn't just about whether inflation cools, it's whether this incoming data confirms the widely anticipated softening economy, or if, that stubborn consumer strength will defy expectations and really force the Fed's hand.
That's the core uncertainty. It's what will dictate the immediate direction for the 10-year yield, which, as we know, is the true lifeblood for tech valuations.
So until we get that clarity,
you have to assume range-bound behavior. You wait until a major, high-volume break confirms real conviction.
Okay, let's pivot to where the action is already happening.
Yeah.
The stocks showing high pre-market volume, the movers. Are gap and go candidates?
Yeah, let's see them.
Roku. RKU is surging over 4% pre-market. The reason here is a simple, clean catalyst, a Morgan Stanley upgrade.
Coupled with a price target hike.
A significantly raised price target. That's institutional conviction translating directly into price.
That's a textbook analyst momentum play. But the real volatility, the one everyone's watching, is AMC Robotics. AMCI. It is rocketing up more than 48% pre-market. That is not momentum. That is pure speculation.
Undisclosed company news.
Right, which is code for rumor.
That kind of move, a nearly 50% gap before the open, that signals institutional front-running. Big players are positioning aggressively based on something that isn't public yet.
And for you, the listener, that means extreme volatility risk once the bell rings. That move is built on rocket fuel, and it needs intense monitoring.
Absolutely. And then look at the opposite macro correlation. Southwest Airlines, LUV, is up nearly 2% pre-market.
And this is a direct benefit of those falling crude oil prices we just mentioned. Lower fuel costs provide a clean, immediate tailwind for the entire airline sector.
Boosts margins instantly.
Exactly. It's a classic rotation. Money comes out of the commodity complex and into cyclicals that benefit from that price drop.
So that confirms the theme. Capital is rotating, even if the major indexes are just treading water. All right, let's get to the true lines in the sand for today.
The levels.
The levels. Neutral sentiment means we have to be patient and wait for volume confirmation at these key structural points. We don't chase, we confirm. Let's start with S&P 500 futures, the ES.
Today is all about identifying where genuine sustained conviction lies. We use these pivot points, a classic tool, by the way, used by systematic funds, to identify price zones where supply and demand are guaranteed to be tested.
Okay.
A decisive move through these levels will trigger follow-through from the larger players. That's why they matter.
On the downside for ES, our immediate floor, first support level, is right around 6,787. If that fails, we could drop pretty quickly to the stronger structural support floor, the 6,750 area.
And the implication of that 6,787 level is critical. A sustained break suggests selling pressure is intensifying, and it opens the door to those lower zones very, very quickly.
Right.
But if we lose the 6,750 floor, that signals a decisive shift of control to the bears. That confirms the short-term bullish thesis is dead and could accelerate declines into the afternoon. That's the key psychological marker for bears today.
Okay, so on the upside, we need to clear the immediate ceiling. First resistance, that's sitting around 6,851. Beyond that, the stronger hurdle is that second resistance, the 6,885 area.
And a clear move above 6,851 is the first necessary sign of bullish momentum. It shows conviction. However, to truly flip the narrative, to invalidate this current cautious bias, we have to clear 6,885.
And what happens then?
Hitting that hurdle suggests a major short squeeze is initiating. That puts new multi-day highs right back on the table.
Okay, let's move to the tech-heavy Nasdaq futures, NQ, which has been leading the downside all morning. This index is always the market's bellwether.
Always.
Our near-term support is 19,550, but the key technical and, frankly, psychological floor we're watching is 19,400.
And this is vital for growth traders. Holding 19,550 indicates there's still some underlying demand in tech. But a definitive high-volume break of 19,400 would severely damage short-term bullish hopes.
That's where it gets ugly.
That's where the profit-taking becomes something worse. It becomes capitulation.
And for resistance on NQ, the immediate ceiling is 19,700. But the major overhead barrier we're looking at, the level that confirms a renewed bullish thrust, is 19,850.
A decisive high-conviction breakout above that 19,850 barrier is the only confirmation we need for a renewed rally in growth stocks. I mean, that event could usher in a fresh leg higher, especially given the sector's current short interest.
But until that happens,
we have to assume sellers are just waiting above that level to pounce.
Okay, so given that neutral sentiment and the paralysis ahead of the data, the tactical choice facing traders today leans heavily toward what we call a liquidity trap.
That's the consensus institutional read. A liquidity trap means the market looks busy, but it lacks genuine direction. It has no real conviction.
So what does that look like?
It looks like quick up and down movements, those famous fake breakouts that reverse within minutes, quick fades back to the mean, and just a lot of choppy sideways trading.
And the telltale sign is volume.
Exactly. Volume spikes on those intraday reversals, but it lacks the sustained flow needed to confirm a real trend.
But wait, hang on. If robotics and automation is the strongest sector pre-market, why should we abandon the idea of a directional day? Isn't that ignoring a potential momentum move?
That's a great challenge. The reason the automation strength is structural, not just tactical for today, is because it's driven by multi-year capital expenditure. CapEx. It's not just a quarterly earnings bump.
I see.
This strength is illustrative of a massive long-term rotation, a secular trend driven by two huge macro factors, accelerating reshoring initiatives and a persistent labor shortage here in the U.S.
Which forces companies to automate.
It's forcing industrial giants to push massive amounts of money into CapEx for automation. It's a long-term story.
So the tactic for the trap remains. Avoid chasing quick intraday moves in the indices. Instead, focus on fading those extremes within the support and resistance ranges we defined.
Patience is paramount, especially when you know CPI and NFP are just around the corner. The money flowing into robotics is a long-term allocation, not necessarily a directional signal for the S&P 500 today.
All right, let's run through three specific illustrative setups that are grabbing attention, and let's dissect where the lines are drawn for conviction.
Okay.
Ticker 1. Quantum Tech Solutions, QTS. News is swirling about a major breakthrough in quantum computing error correction.
The bull case level here is aggressive. It's above $150. If that error correction news is confirmed, it validates the entire thesis for scalable quantum computing. It's a paradigm shift.
And that would attract
Massive, patient institutional capital looking to front-run the next decade of tech growth.
But the flip side is the bear case level, below $120.
Yeah.
If those rumors are debunked, or if the breakthrough is just incremental, profit takers will swamp the stock, pushing it right back toward valuations based on current, less speculative revenue. High expectations yield sharp pullbacks.
Always. Okay, ticker 2. Global Agri-Tech Innovations, GATI. They just announced a strategic acquisition of a vertical farming company and put out a strong Q4 pre-announcement.
The bull case level I'm seeing is above $85. That acquisition solidifies GATI's market leadership in sustainable food production, a key macro theme right now, and the pre-announcement validates their growth trajectory.
But the bear case level sits below $70. The risk here is integration. Acquisitions always carry execution risk, especially when you're combining different ag technologies. If the market smells high integration costs or delays, it will punish the stock immediately.
Got it. Finally, ticker 3, Telehealth Dynamics, THD. They got a major contract award from a large national healthcare provider for their AI-powered remote monitoring system.
And that follows favorable regulatory guidance.
Right.
So the bull case is above $110. This is a validation of their scalable tech, and it establishes a significant recurring revenue stream. Plus, those favorable regulatory wins reduce a lot of the policy uncertainty that's capped this sector.
But deployment is always the issue, isn't it? The bear case level is below $95.
Of course.
Deploying a system across a major provider is a huge logistical lift. If that initial rollout proves slower or more costly or meets stiff competition, the market will reevaluate future revenue potential very, very quickly.
Okay, we have to zoom out now. We need to link these individual stories back to the structural drivers. We need to focus on the two macro anchors that dictate the fate of all these growth tickers.
The 10-year yield and the dollar index.
The 10Y and the DXY.
Let's clarify this for everyone. Why does the 10-year matter so much, especially for a name like QTS or THD?
The 10Y is the cost of money. It's the primary discount rate for future cash flows. So a rising 10Y is a powerful headwind for tech because higher rates reduce the present value of future profits.
And these companies are all about future profits.
Exactly. Their earnings are projected way out into the future, so their valuations get instantly pressured. It's simple math. The higher the rate, the less those projections are worth today.
And the strengthening dollar index, the DXY.
A stronger DXY is also a strong headwind for global tech giants. Think of any company earning major revenue overseas. A stronger dollar makes their products more expensive for international buyers, reducing demand.
And hurts when they bring the money home.
Drastically reduces the value of those repatriated international earnings when converted back to U.S. dollars. Both of these indicators have to be on your screen alongside the S&P levels we outlined.
This brings us to the critical risk for today, especially if data starts to move the needle. The pain trade.
The pain trade. If we see the 10-year yield spiking sharply today, let's say in anticipation of a hot CPI report, the pain trade initiates. And this isn't just a mild pullback.
Right.
It's the move that causes the maximum loss to the largest number of participants.
Yeah.
Smart money quickly rotates out of those long-duration growth stocks, overwhelmingly tech and into value, financials, and cyclicals.
Sectors that benefit from higher rates.
Or at least have more immediate earnings, less sensitive to that future discounting.
And the trap for the retail investor is that they get caught holding the bag. They're trying to buy the dip in tech while the institutional money has fundamentally shifted focus.
Precisely. They are slow to adapt, they cling to those depreciating assets, and they completely miss the upside in the new leadership that benefits from higher rates. This is the ultimate lesson in duration risk. The pain comes from underestimating how quickly a rate spike can reprice entire segments of the market.
So, as we head toward the implied open, the neutral sentiment demands immense discipline. We have to see volume confirmation at those key structural levels, that 6,750 floor or the 6,885 ceiling on ES, before committing to any directional trend today.
Stay patient.
Stick to your ranges until the macro data forces the market's hand.
And here is the final thought you need to carry into your trading session today. The market's current structural weakness is centered in long-duration growth tech. If the non-farm payrolls and CPI data this week come in significantly hotter than expected, if the consumer truly defies all expectations, the resulting spike in the 10-year will not just be a dip you can buy for a rebound.
It'll be a pivot.
It'll be a structural pivot that changes sector leadership for months. You need to ask yourself right now whether your portfolio is prepared for a sustained rotation out of growth and into cyclicals, if that macro data definitively confirms rates must remain higher for longer. That preparation separates strategic investors from those who simply chase momentum.